Broadcom Inc. is currently trading at $350.22 USD, representing an intraday increase of 0.90 points or 0.26% during this Friday, December 26, 2025 session. While the broader market shows a post-holiday drift with light volume, Broadcom is holding its ground in a way that suggests a quiet accumulation phase rather than a speculative frenzy. If you look at the screen of your Interactive Brokers trading platform, you might see a stock that appears to be resting, but the reality beneath this price action is far more complex than a simple breather. Most investors look at Broadcom and see a company riding the coattails of the artificial intelligence boom, perhaps as a secondary play to Nvidia stock. They expect the growth to be linear and the margins to stay pristine forever. However, the reality is that we are witnessing a massive structural shift in how data centers are built, and Broadcom is essentially the architect of the plumbing that makes it all work. While the headlines focus on the latest GPU, the real story is in the networking silicon and the custom accelerators that allow these massive clusters to communicate. The curiosity loop for today isn't just about the current price, it's about why the stock dropped after reporting record numbers on December 11th. It's the classic case of the market pricing in perfection and then reacting with confusion when the perfection looks a little different than expected. The recent movement in Broadcom has been a masterclass in market psychology and institutional positioning. After hitting a 52-week high of $414.61, the stock has faced significant selling pressure, particularly following the fourth quarter fiscal 2025 results. Even though the company reported revenue of $18 billion and guided for a massive $19.1 billion in the coming quarter, the market fixed its gaze on a slight compression in gross margins. This is where the gap between expectation and reality becomes a chasm. The expectation was that Broadcom would maintain its legendary software-like margins even as it scaled its hardware business. The reality is that as custom AI accelerators, or XPUs, become a larger part of the revenue mix, the physical cost of producing those high-end chips naturally eats into the percentage of profit per unit. For a self-investing individual using a Robinhood app or a Fidelity mobile app, seeing a 100 basis point drop in projected margin might feel like a red flag. But for the institutional heavyweights like Vanguard and BlackRock, who hold over 75% of the float, this is simply the cost of capturing the dominant share of the next generation of data center infrastructure. They are looking at the 74% year-over-year growth in AI semiconductor revenue and realizing that Broadcom is essentially becoming the sole provider for hyperscalers who want to move away from off-the-shelf parts and toward bespoke silicon. If you are managing your own online investment through SoFi Investing or checking your holdings on investing sites, you have to look at the volume spikes that occurred in mid-December. We saw trading sessions where over 70 million shares changed hands, which is nearly 3 times the typical average. This wasn't just retail panic, it was a massive rotation. Some of the smart money was taking profits after a 50% run-up, while others were using the dip to build long-term positions. It is fascinating to compare this behavior to how investors treat Apple stock or Tesla stock. While those names often move on consumer sentiment or social media hype, Broadcom moves on the cold, hard math of capital expenditure from companies like Google, Meta, and Microsoft. These giants are spending tens of billions of dollars on AI infrastructure, and they aren't just buying GPUs, they are buying the Tomahawk switches and the Jericho routers that Broadcom produces. When you look at your individual brokerage account today, don't just see a number like 350.22. See the fact that Broadcom is currently holding above the critical support level of $345. This level is being defended vigorously, which suggests that the institutional floor is much higher than the bearish narratives would have you believe. Comment below how many shares of Broadcom you currently hold, and let me know if you think the margin concerns are overblown or if they are a sign of a slowing growth cycle. Understanding the business model of Broadcom requires looking past the ticker symbol. For years, this was a company built on a ruthless strategy of acquisition and integration led by Hock Tan. The purchase of VMware was the most significant move in the company's recent history, and we are finally seeing the fruits of that labor. The infrastructure software segment now accounts for nearly 40% of total revenue, and it carries the kind of gross margins that semiconductor companies can only dream of. When you use Fidelity Wealth Management or a SoFi robo-advisor, you are often getting exposure to these kinds of diversified tech giants that provide a buffer against the cyclical nature of the chip industry. The VMware integration has allowed Broadcom to transition customers from perpetual licenses to a subscription model, which creates a predictable, recurring cash flow that supports the dividend. Speaking of the dividend, the recent 10% increase to $0.65 per share is a signal of management's confidence. They aren't just talking about growth, they are returning capital to shareholders at a rate that most high-growth tech firms simply cannot match. This balance between aggressive R&D and AI and a stable, high-margin software business is what makes Broadcom a unique entity in the semiconductor world. The technical setup for Broadcom right now is one of consolidation. After the aggressive sell-off from the $400 level, the stock has been carving out a base. On the Robinhood stock trading interface, the moving averages might look a bit messy, but the long-term trend remains firmly up. The stock is trading above its 200-day moving average, which is the ultimate line in the sand for institutional buyers. When you look at Fidelity brokerage or Interactive Brokers fees for active trading, you realize that the cost of entering a position here is negligible compared to the potential upside if the company hits its 2026 targets. Analysts have a median price target of $450, which represents a significant premium from the current $350.22. The reality is that Broadcom has a record backlog of $110 billion. Think about that for a second. Even if they didn't take another order for months, they have years of work already lined up and paid for. This is the kind of visibility that you rarely see in the tech sector, and it is why the stock carries a premium valuation. While the price-to-earnings ratio might look high on a trailing basis, the forward-looking metrics tell a different story of a company that is growing its bottom line at over 30%. The relationship between Broadcom and its peers like NVIDIA stock and Marvell is also worth watching. While NVIDIA provides the brain of the AI system, Broadcom provides the nervous system. Without the high-speed networking and the custom ASICs that Broadcom designs, those GPUs are just expensive paperwork sitting in a rack. This is why the expectations for 2026 are so high. The market is waiting to see if Broadcom can sustain its lead in the 800G and 1.6T networking space. If they can, the current price will look like a bargain. If competition from companies like Cisco or homegrown solutions from the hyperscalers themselves starts to chip away at their moat, then the margin compression we saw in the last report might be the beginning of a longer trend. However, the technical complexity of what Broadcom does is immense. It isn't something that can be replicated overnight. For those using online investing tools or seeking investment help from a professional at Fidelity IRAs, the focus should be on the long-term structural demand for data throughput. We are moving towards a world where every piece of data needs to be processed by an AI model, and that requires an incredible amount of bandwidth. Broadcom owns the patents and the designs that make that bandwidth possible. As we look towards the future, the catalysts for Broadcom are clear. We have the continued rollout of VMware Cloud Foundation, which is helping enterprises build their own private AI clouds. We have the expansion of the XPU business with at least 4 major hyperscale customers now on board. And we have the inevitable upgrade cycle for networking gear as data centers move to faster standards to keep up with the next generation of AI models. If you are managing an intelligent portfolio or using Schwab intelligent portfolios, you likely have exposure to these themes, but seeing them play out in a single stock like Broadcom is a different experience. The risk, of course, is that the massive capital expenditure we are seeing from the big tech companies might eventually slow down. If the return on investment for AI doesn't materialize for the likes of Meta or Google, they might pull back on their hardware orders. But even in that that scenario, Broadcom's software business provides a massive safety net. It is a dual-engine growth story that most investors still don't fully appreciate, often getting distracted by the daily swings on the Robinhood app or the latest news cycle about China's domestic chip production. Institutional activity in Broadcom has been telling. While retail traders might be worried about the 20% drop from the highs, the big funds are using this period to rebalance. They are looking at the free cash flow, which hit over $7 billion in the last quarter alone. That is an incredible amount of liquidity that allows Broadcom to keep buying shares and raising the dividend. When you look at your Fidelity trading platform or Interactive Brokers account, pay attention to the institutional ownership percentage. If that number stays high, it means the pros are comfortable with the valuation. They aren't just betting on a chip company, they are betting on the fundamental infrastructure of the internet. The reality